All right, folks. Now we have chapter 4 and 5 in one because they're linked closely. So I did say I'll upload 5, 6, 7, 8 tomorrow, but it's going to be 2, 3, 4, and 5 today, and then 6, 7, 8 tomorrow. Now this chapter is going to talk about an example of a time-based model and how to trade it. It's an example. You don't have to stick to this one. You can if you want to, but it's showing you how to build and how to trade one. If you so choose, of course. The model is Wednesday model. And it depends on the daily and weekly candles. The weekly and daily charts are gold mines for those with a shovel, and a good one. The better quality your shovel is, the more money you will make with these two charts. We have here Euro, the weekly chart, which I called for you on Twitter. And in it, we'll see an important phenomenon, which is there's an 81% chance that the high or low of the weekly candle forms between the Sunday open and the Tuesday London session. And there's a 70% chance of Tuesday printing the high/low of the week. This is a concept discussed by many great minds in the realm of technical analysis. One of them, most notably, is William Gann. And of course, not a surprise, but also ICT mentions this in his teachings, which is true. Tuesday has a high chance to print the high of the week. And to make things even more focused, because I'm reminded of the quote, and this quote keeps popping up in my head the more I used to study the charts. Then I always had this in mind as I was learning, which is the quote of Arthur Conan Doyle. In the book Sherlock Holmes, where he says, once you eliminate the impossible, whatever remains, no matter how improbable, is the truth. Right? So once you eliminate the impossible, whatever remains, no matter how improbable, must be the truth. And that was an inspiration for one of my famous diagrams, which have circulated the internet, of the possible shapes of the daily candle, which I will link in the group. So as you can see, this is a beautiful example of a classic by week. There's many different ways the weekly candle can print. And you can trade them all. You can trade all of them. I can trade all of them. Anyone can trade whatever he wants. However, if you put all your energy, which you're wasting trading ranges, and I mean ranges when there is a chance of an expansion. Ranging markets are my favorite, but if there is a chance of an expansion and you only trade the range, then you're missing out. Right, so this shape, open, buy below the open, and then hold till the close. You don't close when it reaches this high. You close on Thursday. Right, so I'm entering on certain days and exiting on certain days, which will cap the range. You understand? In this case, I had alerted you, pretty much free money if you're focused, that this is the low of the week on euro. Monday, Tuesday, Wednesday mark the low of the week, and Thursday, Friday mark the opposing end of the range. Now, taking into consideration the two previous data points, this means that there's a high chance that Wednesday will print a classic buy/sell candle in the weekly and daily order flows direction. It's not a guarantee. And when I say buy and sell candle loosely, right? Because for me, as long as I can buy below the open and sell at the open, that is a success. As opposed to pattern trading the power of three. That is another mistake, right? So you'll trade the pattern. I'm trading the logic of open, low, high, and close. If you looked for trades which go from the protraction, the Judas swing, back to the open, and that was enough, that was all you did for the day, then you would find a lot more trades and you would be a lot more successful in catching trades. And in this instance, I'm reminded of another quote, which is, have an opinion on what the market should do, but don't decide what the market will do. Be happy with a percentage of the move. Variations depend on what day the PDRA is hit, which creates the weekly low. This is a rough depiction of the Wednesday model. Opening time, rise key level down to the opening price. All right, so the 1 o'clock candle creates the high of the day, and the 9 o'clock candle gives the retracement, protraction, and expansion. Price leg distribution number 1, protraction distribution number 2. Right? That in itself was a model just now. A more detailed look would be open, we rally, we are bullish on the higher time frame, right? Because you always have to pair one time frame with the other one. So we're bullish on the higher time frame, opening price, rally, fake out of the pattern Judas swing traders, range, so rally, range, turtle soup at a key level, turtle soup, breakdown. Now there's a change in the state of delivery on the higher time frame, which is a market structure shift on the lower time frame, right? An order block on a higher time frame is a breaker on the lower time frame, and a breaker signifies a market structure shift. That all comes second to the time all this is happening, right? Open, London, high of the day, New York OTE, and we go down. Here's a real life chart example of the Wednesday model. You have open. This is, of course, the 5 p.m. open, right? So if you want the midnight New York open, it's going to be around here, right? So open, decline, hit the key level, the previous low, retest the body of the previous low, right? Range low, range high, range low, retest the body of the previous low, and rally. On the higher time frame, you'd find a PDRA, which stopped this rally. This decline, excuse me. So open, decline, range low, change in the state of delivery, shift in the market profile, not a pattern, shift in the market profile. So we go from breaking lows and rejecting highs to finally breaking this swing high. As soon as we break the swing high, then we can start looking for a deep retracement, which will scare off anyone who bought up here and scare off anyone who's looking to buy, right? Because down here, you had dumb money selling. When it rallied, you had dumb money buying. And the market's function is to trip and offset as many positions as they can. Right? So someone, hopefully none of you, someone sold down here and bought up here and sold down here again because of decline, right? Pattern FVG, pattern trader. And those people are the liquidity which we rely on. And it is the logic I always have in mind. I never think what happened. I think, why did this happen? Right? As I'm living this candle alive, someone sold down here. Someone sold down here. Someone bought up here. Of course someone did. It's an old high, right? Range high. And beautiful range low to range high. Never changes. So back to Wednesday model. That is a price observation rant. I'll leave the details for the next chapter. Open, decline, create a range, turtle soup, break out of the range, and then rally. Another example of the Wednesday model over here. You have Wednesday. Open, range, when the time is right, turtle soup, change in the state of delivery, and a shift in market structure. The market profile has changed. We went from breaking lows to breaking highs. So now it's bullish. It's not a pattern. It's showing that smart money is no longer willing to sponsor the shorts. Right? As soon as you break above this high, you're bullish. Yes, but we wicked down here. Yes, but if you remove the wicks, you'll notice that we never closed a body below this low. Wicks do the damage, and bodies tell the story. And you'll notice this a lot about FVGs and order blocks. In fact, this is a good homework, which is go back and remove the wicks and see what you get. So open, range, turtle soup at 3 o'clock, right? Because we know that there's a recurring 2 a.m. model every day. And if 2 a.m. is a manipulation, then the manipulation is leading to a swing low at 3, right? 3 a.m. is an important time for turtle soup, which no one mentioned until I did, and then some people have recently started mentioning it, but nobody was aware of that time before I mentioned it. So it's good to finally see it going mainstream. 3 a.m. is an important time to look for turtle soup. Next up, you have the OTE continuation, right? So you have accumulation, manipulation, distribution, consolidation,